Good morning, ladies and gentlemen. With our feature on earnings for the fourth quarter, we bring you some of the finest performances that have seen in corporate India. Joining us on the show is the management of Lupin, Mr. Ramesh Swaminathan, Executive Director, Global CFO, and Head of API is with us. The numbers of Lupin will appear with you on the screen. The stock is up 27% over the past 12 months, handsomely beating the Sensex and its own sectoral index, the BSC Healthcare Index, and the numbers have been phenomenal. 115% rise in annual quarterly profit at 782 crores versus 368 crores in the year ago period, and sales rose 14% to 5,667 crores. The data will keep on appearing on the screen. Namaste to you, Rameshji, and a very warm welcome, sir. How do you look at the fourth quarter gone by? What have been the highlights of this phenomenal performance?
So the momentum that we had set a few quarters ago continued into the fourth quarter as well. The results from America were particularly pleasing. We exhibited pretty decent growth again in the Q4 at 13%. And this is in line with, in fact, our expectations, given the fact that we have the top line buoyancy was kind of sustained over the fourth quarter, and as with the previous quarters as well. The mainstay was, of course, products that we introduced in the recent past, Mirabegron, whilst, of course, there was contribution coming in from at least a couple of other products as well. So we had Rivaroxaban, which we launched this quarter. There was contribution coming in from prednisolone as well. Apart from that, there was this traditional, which has been going on for some time, which is Albuterol and Spiriva, not to speak of inline products like Lisnopil and the like, which contributed. We are also particularly pleased with, in fact, our development of the way things have evolved in Europe. There again, we've seen tremendous growth over the last several quarters, particularly this year, on the back of products like Lufobec that we launched in UK and a generic version that we launched in Europe. India was a little, lackluster because of the fact that, or seemingly lackluster, given the fact that we had loss of exclusivity on a couple of products when it comes to diabetes. The empagliflozin range, there was loss of exclusivity, which actually impacted the results a bit. API, of course, is a cyclical business. But overall, we were particularly pleased with, in fact, the overall development. But much more pleasing was the fact that the margins front were pretty good. So we reported 23.2% this particular quarter, and this is after taking into account an enhanced spend on the R&D front. That is a good 100 crore more than the previous quarter. And there was a lowering of, in fact, the PLI benefits that we got to the extent of at least 47 crores. So that impact would have been about 2.8%. So if I add 2.8% to the 23.2 that we reported, it would be close to 26%. So clearly, the gradient of the slope has kind of been sustained. The margins have increased. Overall, if you look at for the full year, last year we reported about 19%. This year we have looked at 24.3, so essentially 23.7. So essentially for the full year, done extremely well from an EBITDA margins perspective.
Right. Mr. Swaminathan, let's look a bit ahead for the next 3 to 4 quarters. What is in your pipeline as far as the US geography is concerned? And how do you see the guidance from this point onwards? Of course, this 115% rise in quarterly profit for the 3 months gone by, is it something which is sustainable?
As long as the top line buoyancy is maintained across America and other parts, there's no reason why our margins, in fact, would not continue to rise. You would see that, the buoyancy being maintained, given the fact that you've got a number of interesting products lined up across various markets. For example, in America, we have Tolvaptan that we just launched a couple of days ago, and it's a product that we would have exclusivity for several months to come. So from that perspective, we clearly are pretty enthusiastic about the future. But it's not the only product, so we are working on a number of products for the next several quarters, so to speak. When you speak about the respiratory, we have in fact got into, there's no particular product, no product that you're not investing in for the future. So we've got the Respimat, Ellipta formats coming in over the next several quarters, so to speak. We have a number of complex injectables that you're working on. So those would, of course, get released in the course of this current year as well, which could include products like liraglutide, glucagon, and the like. And of course, Risperdal Consta. We're particularly enthused by, in fact, a pretty unique platform that we have, which is Nanomi, coming in from our Netherlands facility. This particular platform is particularly good at producing nanoized features for long-acting injectables. So we are placing a lot of store by this particular technology as well. Pretty enthusiastic about our biosimilars prospects for the long term, given the change in regulatory framework in America. First is, of course, the interchangeability that has been brought in. The advent of private labels in that market is, of course, is another pretty alluring factor. And the last, of course, is the fact that biomarkers are being acceptable for certain molecules when it comes to instead of doing the normal PD studies out there. So from that perspective, given the fact that we are into a lot of this complex stuff, the future in America looks very pretty alluring. Equally, the strategies that we have stored for that you're working on in India, which is, of course, a very rich pipeline for India.
When you say the future looks a little alluring in America, there are two negative outcrops that have come in because of what Mr. President Donald Trump has done. One, of course, he wants generic prices to come down between 30 to 80% in the US. And on top of that, there is this threat of tariffs on pharma. Even for you, the American market is the largest component of your business, as also for the top 4 or 5 domestic pharma companies. How are you reading and anticipating this threat?
Firstly, the executive order is not about generic pharma. It is about, in fact, pharma in general. And clearly, what he is actually targeting is essentially the ethical pharma companies with IP. So from that perspective, he does expect, in fact, pricing to be, from an MFN basis as compared, to the other developed world, so to speak. Clearly, that's something which will work, against the interests of potentially IP-driven companies. Of course, it'll have a ripple effect when it comes to generic companies also, because in some ways, generic pricing is kind of anchored to potentially, the IP-driven companies. But that said, generic pharma is all about access to medicine, and India has this advantage of affordable medicine, so to speak. The affordability aspect is to be protected. That would certainly work, against him if we were to do anything, which kind of negates this proposition.
Mr. Swaminathan, I'm not sure if I'm able to put it across to you in a simple manner. Your largest market has a threat of tariff and the overhang of a massive price cut. How do you think that will impact sales and profit and profitability, not only at Lupin, maybe on a wider industry basis?
No, I'm trying to explain to you that the threat is more for companies which actually have IP-driven products. The generic industry is going to be relatively immune to this. So we still continue to be pretty enthusiastic about that market, given the pipeline that we have and the like. Clearly, the threat of generics, let's see how it plays out, because currently it's exempt. There's, of course, a overhang in terms of the tariffs being imposed on API sourced from China. But those are, again, several moving parts there, because essentially it's still in trade talks with China and the like. So at this stage, we are not impacted, and there's no reason to kind of feel dampened about our prospects for that particular market.
Fair point. In terms of expansion at your existing facilities, or maybe adding a new facility, what are the next 3 or 4 quarters looking at?
If you're alluding to, in fact, our expansion plans for America, clearly, we have a couple of plants out there. One is at Somerset, another is at Coral Springs, which we use for potentially products which are strategically important. And we would continue to work on those plans. Clearly, two things dominate. One is, of course, the strategic importance of those products, and the second is essentially economics. And those products that we believe can potentially be done out of an American facility, we go ahead with our plan as well.
So that's what I ask. What President Trump is saying, that as long as you produce in my geography, you will be safe from tariffs. So, what, according to you, will be Lupin's plan? Will you expand existing US facilities, put in a new one? How do you plan to overcome this threat?
So clearly, as I was saying, it really is going to be dependent on the kind of products that you have for that market. There are certain products where it makes sense to actually produce for the out there, and just some parts, in fact, the respiratory portfolio. Whilst a lot of others would potentially make a lot of sense being produced out of India. So that's the paradigm that we have always professed and will continue to profess. And clearly, with an expanding respiratory portfolio, the manufacturing facility in America will also, gain importance.
Okay. You have an outstanding debt of about 2,700 crore rupees, and net cash you're positive because cash is at about 2,900 crores. Is this debt picture you are comfortable with? What do you think will be the debt profile over the next 12 months or so for Lupin?
Clearly, we are a cash surplus company today. That's because there is very good cash coming in from operations itself. But having said that, it's not as though we want to be stuck with, in fact, just cash without, because we are a pretty acquisitive company. Our actual requirements for potentially fixed assets and the like manufacturing facilities is not going to be pretty high. But as I said, we are, we are an acquisitive company, and if the proposition is compelling enough, we would be looking at acquisitions in India. We'd be looking at specialty assets in every part of the globe, more particularly in America. And as and when it, if the proposition is necessary for covering certain white spaces in our distribution program in Europe, you'd be looking at some assets out there. But it's not as though we believe in being a debt-free company, because we really would like to trade on equity, and that's what actually increases the value for shareholders.
Fair point. Mr. Swaminathan, when you mention about potential acquisitions, are there any therapies that you wish to add to in terms of new purchases, or is it you'd be keen to buy out a rival that might improve your operating margins in a certain therapy set? What is your target audience when you say you are looking out on an acquisitive spree?
So clearly, India is an important market for us, and therefore acquiring products, either by way of acquiring companies, of course, would be a possibility. There could also be buying a range of products. So it really depends on the overall proposition itself. But clearly, we're looking at bite-sized acquisitions here also. Our sweet spot is somewhere between 250 to 300 millions when it comes to an individual market. We are also enthused about the prospects for specialty, and we have been looking at specialty for quite some time, more for America, and possibly if it does have a possibility of actually the same product being sold in Europe, we would be happy with that as well. So that's going to be another important area for focus.
Mr. Swaminathan, you are the global CFO. How far have some of these acquisitive talks reached as far as potential buyouts are concerned? Anything in the offing that shareholders can look forward to?
We are always in talks, and there are discussions about several propositions, but unless it meets our strategic vision and, of course, our financial parameters, we're not going to bite. It's buy at a cost which is affordable and there's value in it for us, and not buy at all costs.
Fair point. Thank you, Mr. Swaminathan. It's such a wonderful discussion on the pitfalls that are there in the US market, of course, the wonderful nature of that business, and of course, how you plan to tackle those minefields. Thank you so much for your time. We look forward to higher operating margins from Lupin over the next 4 quarters, and of course, a lot of buyouts that might add both to your top line and to your existing portfolio of products. Have a nice day.
Pleasure is mine too.
If you like the video, do like, comment, share and subscribe. If you like the video, do like, comment, share and subscribe.